What's going on, guys? It's Jordan DeYoung here, and today we have the March 2020 Corelogics monthly chart pack review. Been waiting for this one for a little while. It's now the 11th of March and it's just come out, so keen to delve in, especially with the whole coronavirus hitting the market and everything else, to see if it's had any implications so far and if they've got anything to talk about in here. I haven't read this report just yet, so bear with me and we'll go through it together. So normal starting page. Residential real estate is now $7.1 trillion. Superannuation is now $3 trillion. Stocks is $2 trillion, and commercial real estate is $1 trillion. So I'm pretty sure those numbers have come up, which is, yeah, like the residential real estate, I'm pretty sure was $7 trillion last month. So I'll have to check that out to confirm. But yeah, again, it just reinstates how big the residential real estate market is compared to everything else, superannuation, stocks, everything else. So good signs there. Not a lot of movement in the numbers below, it doesn't look like. 10.4 million number of dwellings, 1.82 trillion outstanding mortgage debt. So still only, 1.8 trillion in debt compared to 7.1 trillion in actual real estate. So, when you take that in the scheme of things, it's not a lot of debt to real estate ratio there. 51.5% of household wealth is held in housing. 437,000 total sales per annum and 267.8 billion gross value sales per annum. Growth in national dwelling values was 3% in the 3 months to February, making 5 consecutive months of quarterly growth. Yeah, so see the combined capitals, they're starting to come down again now. We sort of start to see that in, I think it was December maybe, or yeah, maybe December quarter, we started to see it like peak off a little bit, and now it's starting to come down again. So that's very interesting to see. Still growth in that quarter. So 3 months to February, making 5 consecutive months of quarterly growth, but we are seeing those combined capitals start to come down again. But yeah, interesting enough, it's not, obviously we're not seeing some negatives. It's just not growing as much as predominantly as we saw earlier in sort of late 2019 there. So yeah, very interesting. We can sort of taper off, but yeah, still some pretty strong growth. Sydney and Melbourne still being the stronger growth ones, with Hobart and Canberra falling behind. Darwin still in the negative, but Brisbane, Adelaide and Perth still trucking along there. But yeah, we're still seeing growth, but it's starting to taper off a little bit, so it's not coming as quickly of a rise as it was. Regional market growth accelerated over February, but divergent performance between the regionals and capitals continue. Annual change in dwelling values. Yeah, so annual change February, annual change in dwelling values. Yeah, okay, so this is annually. So the previous one is quarterly, and this is annually. So we haven't seen that taper off yet because it's on an annual basis. So it's comparing, years upon years instead of quarters upon quarters. So we're still seeing that really good growth come up. Yeah, Melbourne and Sydney, they're still strong at, above 10% growth, which is just phenomenal on an annual perspective. So the Australian average over the last 25 years has been 6.7% or something like that, close to that, or 6.8% I think maybe. So yeah, to see 10% growth there is quite strong, and it's probably a pretty good period between after the federal election, mid-2019 to around about now. Nationally, the high end of the market continues to be the highest growth segment, but the median is gaining momentum. Nationally, the high end of the market continues, yeah. So as I said in the previous videos, when we see sort of a growth spike, it's normally from these top end properties where, people are, there's no real sort of median price point. So when we look at the median price point, it's kind of easy for us to compare apples against apples. But when you talk about the higher end of the market, where these really high working professionals with high income have additional money with the borrowing capacity in the market currently, they tend to bid more and more and more on these types of properties that are going to be their forever home or family home or whatever. And it's that emotional connection with the property in itself which makes them want to buy. And then obviously this sort of frenzy coming back into the market now is sort of collided with that, and everyone's building quite rapidly or bidding quite rapidly to get into the market. So we sort of see that high end drive the growth to start with, and then we start to see that sort of 50% and the bottom 25% sort of follow as well. But we can see this again in Melbourne and Sydney. If it's 10% over the region, you know, the top 75% is at, you know, 13 and 14% respectively. So we can sort of see these two markets really driving the charge, and then followed by the sort of 50% in between, and then at the lower end as well. But yeah, as we can see, Brisbane's and Adelaide are sort of doing the same. The top end in Adelaide is actually coming down. Perth's still coming down, but not quite as slowly as last month. Hobart had the bottom end is growing in that perspective, which is quite interesting. Darwin's down and ACT is pretty flat. Dwelling values increased in 6 of the 8 capital city markets in the year to February, with Sydney and Melbourne now at double-digit annual growth rates. Yep, so we're seeing those 10% growth rates since mid-2019. As you can see, how much of a rebound this really is, this V-shaped recovery. Obviously not seeing any effects of the coronavirus here or what impact that's going to have on the economy, but I think we'll start to see an impact once, you know, if jobs start to go down, unemployment, underemployment start to come up, wage growth starts to halt, which it pretty much already is, but if wage growth really starts to halt, you know, people aren't really concerned about buying property as an asset. They're more concerned about finding the next job or putting food on the table. So it's going to be interesting to see how much happens there. I mean, the government are obviously putting some stimulus in the pockets now and trying to prevent that recession happening. So we'll see what they'll be able to do there. But yeah, obviously no visual impact on the property market right now. But yeah, as we can see, Brisbane and Adelaide still sort of flat, but underneath that 2% and between 2 and 0%. And the rest of the capitals, yeah, Perth and Darwin are in their negatives still, and then Australia, ACT and Hobart are still pretty strong around that 4 to 5% growth mark, so not too bad there. Quarterly, the annual change in dwelling values, Sydney. So yeah, as we can see, quarterly, this is starting to growth and this is annual. So quarterly and annual is the line. And as we saw before, you can't really see the changes in the annual thing, but we can see these quarters sort of start to spike up and then they're coming down now. So, you know, eventually we probably will see this taper off a little bit from the annual change. But Sydney dwelling values increased 1.7% in February. Dwelling values increased 4.6 in the quarter. That's pretty good. Sydney dwelling values are up 10.9% in the past year. Sydney dwelling values are 3.7% below the record high, which was July 2017. Yeah, so still below their record high. As we'll see, 5 of the other markets are actually at their peak now. So Sydney still probably has a little bit of growth left in it before it sort of completely levels out or it might even overshoot, we don't know. But yeah, still a little bit of growth left in Sydney if it does reach those peaks that it was before, as the rest of the cities have done. Melbourne, same sort of thing. Can't see much on a yearly, but on the quarterly basis, we can start to see it come down. Melbourne dwelling values increased by 1.2% in February. Dwelling values increased by 3.9% in the quarter. So yeah, a lot less than Sydney. We're sort of seeing a slowdown in the growth there. Melbourne dwelling values are up 10.7% in the past year. So we must have seen a much more stronger growth in Melbourne earlier in the year, which is kind of, you know, this sort of peak here, or maybe not much of a dip. Yeah, it's pretty average, but you know, when you're comparing 10.7 in Melbourne to 10.9 in Sydney, and you know, the last quarter in Sydney outdid Melbourne by, you know, 7.7 percentage. It's pretty significant. Melbourne dwelling values are now at a record high. Yep, so Melbourne's at their record peak levels now, so interesting to see that. Brisbane, seeing that quarter growth come down a little bit, nothing on the annual change as well, but obviously not as dramatic a V shape as Sydney and Melbourne. You look at those matching V shapes from Melbourne and Sydney, and then this sort of U shape or yeah, slower sort of growth pattern from Brisbane, but still some recovery there, which is good. Brisbane dwelling values increased by 0.6% in February. Awesome. Dwelling values increased by 1.7% in the quarter, so that's not bad for Brisbane. Brisbane dwelling values are up 1.9% for the past year. So yeah, we're starting to see that growth come in the positive now for Brisbane. That must have come through last month as well, but for this quarter they're up 1.9% for the year of the sort of crash between 2019 and then up in 2020. So Brisbane dwelling values are now currently at a record high. Adelaide, again, sort of a slower, not a strong V-shaped drop in recovery there, but pretty stagnant. Adelaide dwelling values increased by 0.1% in February. Dwelling values increased by 0.8% in the quarter. Adelaide dwelling values are up by 0.4% in the past year. So now we've got Adelaide, same again, a bit of a U-shaped recovery there. Adelaide dwelling values increased by 0.1% in February, so not a lot of growth. Dwelling values increased by 0.8% over the quarter. Adelaide dwelling values are up 0.4% in the past year. Adelaide dwelling values are currently at a record high. So even though they're at a record high, there hasn't really been a lot of growth in recent times, but still at a record high, and looks like it's sort of stagnating there, but continuing to grow a little bit as well. So it'd be interesting to see what happens there over the year. Perth, so we're sort of seeing this massive V-shaped recovery from Perth. Even the quarters now are starting to come into positive growth. This quarter obviously isn't as strong as last quarter, but as you can see there, but it's nice to see some quarterly growth there from Perth, which is awesome. Perth dwelling values are up 0.3% in February. Dwelling values increased 0.4% in the quarter. Perth values are down -4% for the past year. Perth dwelling values are now -21% below the record high, which was in June 2014. So still significantly down from their peaks, but starting to see some growth happening now, and hopefully those prices come into the positive by the end of the year. Let's see what happens there, who knows, but some stronger reported data there from Perth, which is great. Hobart, didn't really see a lot of negative growth from Hobart. We're still in the positive now. We can see the quarterly rate come down. So Hobart dwelling values increased 0.8% in February. Dwelling values increased 1.9% in the quarter, which is pretty good for Hobart. Hobart dwelling values are up 5% in the past year. Hobart dwelling values are currently at a record high. So Hobart at a record high, some strong growth in the past year, and still seeing some growth in the recent quarters. Darwin, bit of a slow market there, still in the negative, hasn't rebounded into positive just yet, but values fell -1.4% in February. Dwelling values increased 1.8% in the quarter. Darwin dwelling values are down -7.8% in the past year. Darwin dwelling values are 32.7% below their record high in May 2014. So still a lot of negative growth there. As you can see over the spread of the quarters, they're all very negative, not a lot of positive growth there at all. So still very down and in a low market there. I don't really know much other than Sydney and Melbourne, so I can't really explain what's happening there, but still seeing some negative growth. ACT, see some rise again. The growth per quarters is definitely slowing down, but dwelling values have increased 0.8% in February. Dwelling values are up 1.1% in the quarter. ACT dwelling values are up 4.1% in the past year. So still some strong growth over the past year for the ACT, and they're at a record high now as well. So another one at their record high, and we'll continue to see some growth, obviously at a slower rate based on this quarterly growth here, but still at record highs and continuing to grow. Sales activity over the year has trended higher and is being sustained above the decade average of 37,689,000. Sales activity over the year has trended higher and is being sustained above the decade average. Okay, cool. So sales activity is up higher than the decade average, which is really good to see. So obviously some strong growth coming into 2020. A lot of people, there's been a lot of pent up demand since 2017 with all the APRA changes and all that sort of stuff from investors, although most of the new people coming in are owner occupiers, but still a lot of pent up demand there. So we're starting to see them come back into the market, and obviously seeing this with a trend higher than the decade average, which is this big grey line here. And then I think these would be quarterly, the light blue, and the dark blue would be annually. Or actually maybe it might be national compared to, I think I was right initially, but Sydney there with 20.7% increase of sales. So a lot of sales happening in Sydney, 8.9% in Melbourne, and Canberra's pretty high too at 11.7%. Perth's at 8.2% as well. So four really strong markets there: Canberra, Perth, Melbourne, and Sydney. Sydney obviously taking the charge with a lot of sales happening in the start of 2020 and trending higher in February there. So a lot of people out there on the market wanting to bid. We sort of always see this in the sort of February period because we have that pretty much market closed down between December and January. Everyone's away. There's no auction campaigns, clearance rates aren't being reported, all that sort of stuff. Everyone's in holiday season mode. So we generally see this in the February period, February, March, and then it starts to slow down around that Easter time in April. So it'll be interesting to see what happens over the next 2 months if this sort of sales record continues to go up. But obviously Sydney with the 20.7% there being the most dominant market with recording sales. Annual growth in rent values continue to gather momentum as high levels of investor stock from the previous upswings are gradually absorbed into the market. Yeah, so there was a whole bunch of investor stock that was on the market before and no one was really buying it in between 2017 and 2019. And there was all this talk of oversupply of apartments and house and land estates and house and land packages and all the rest of it. So obviously what we're seeing here is it's being absorbed into the market now as people are coming back and buying quite quickly. So annual change in rental rates national. Annual growth in rent values continue to gather momentum as high levels of investment stock from previous years. So we're seeing this rent value starting to come up as well. I think this must be rental rates. Yeah. So yeah, pretty good there. Hobart being very strong at 5.5%, which is really good. Melbourne and Sydney's actually down, -3%. Sorry, -0.3%. Melbourne, Brisbane, Adelaide, Perth, all really the same around that 1 to 2%. Darwin's down and Canberra is pretty flat. Yeah, pretty interesting there to see that sort of being soaked up into the market. Nationally, gross rental yields were steady over February. Gross rental yields were steady over February at 3.8%. Due to rapidly rising dwelling values in Sydney and Melbourne, rental yields remain compressed in these cities. Yeah, so as you see the price of property go up, the rental yields come down because rentals are a 12-month contract and they sort of stay firm at that. Say you lease a property for 12 months at 4%. As property prices come up, that becomes less and less and less and less and less because your rent still stays the same, but the price of the property goes up. So as a percentage of the overall value of the property price, it's starting to come down. So nationally, in the capitals, nationally is 3.8%, capitals were seeing 3.5%, and regionals were seeing 5%. So Melbourne and Sydney still sitting around that 3%. Or actually, I think that's pretty much come down, and the rest, it looks like. Yeah, the average is about 4%. So strong in Darwin, pretty strong in Hobart and Canberra, Adelaide, Brisbane. So we're seeing stronger rental yields in those sort of markets. But Melbourne and Sydney, which is obviously the growth areas, as we're seeing with that V-shaped recovery, are starting to come down now. So we're seeing that sort of lower rental yield. Days on market crept higher due to the seasonal slowdown in activity, but has fallen year on year in most regions. Yeah, so days on market is how long a listing will sit on the market before it sells. In the sort of high peaks of the lower end of the market, we're sort of seeing 70 days there for the combined regionals and probably 60 days there for the capital. So they're sitting on market for 2 months. And then we saw that significantly come down in the end of 2019. So we're sort of sitting, around 35 days on market for the combined capitals there, which is really good. And then we're seeing it increase a little bit now. As I said before, that holiday season kicks in for December, January, and it's now sort of reporting on that period. So hopefully that sort of stabilizes and we don't see property on the market for as long and it comes down a little bit, but we'll see what happens there. Obviously the quarterly growth is continuing to come down as we've been seeing in those previous charts. So might continue, might stay a little bit higher. I don't know. We'll see what happens there. But strong markets in Melbourne and Sydney. They're only on the market for 35, 37 days respectively. So, they're not sitting on the market for as long. They're sitting out for one auction campaign and maybe a week after or something like that. Or private sales might be on the market for 5 or 6 weeks or something like that, which is pretty solid there. But yeah, if you compare the 2019 to 2020, 71 days on market in Sydney compared to 37 days now. So it's almost half. It's almost half of how long a property used to sit on the market. So it just shows you what the sort of consumer sentiment is out there. Like they're really wanting to buy property and it's not staying on the market for long. They're buying it compared to 12 months ago. No one wanted to buy property. It was just sitting on the market for 71 days. Almost 3 months. It's pretty hectic. Well, 2 months and a little bit, but pretty hectic. Not as significant in Melbourne, but yeah, you can just to see that difference is phenomenal. Most markets have seen a reduction in vendor discounting year on year, with an exception in the ACT. So vendor discounting is their original price that they put on the market, their property for on the market, and then how much they actually sold it by. So how much they're actually reducing their price by, and how much they're discounting their price by. So starting to see that come down as the market sort of fluctuates up higher. Yeah, so if we look at the 2019 to 2020, it was minus 7.7%. So people were reducing the price of their property by negative 7.7%. That's how much they were discounting people to sell their property. Now it's halved, or more than halved, at negative 3.5%. So obviously there's a whole lot more buyers coming into the market. They're buying the properties as they see fit and just bidding like crazy, which is causing this flurry in the market. But essentially they're halving vendor discounting, which is showing a very strong seller's market at the moment. Yeah, pretty crazy stuff. Obviously Melbourne and Sydney being the stronger ones there. If we look at the rest of the capitals, and as they say, ACT is the only exception here where it's actually increased. But yeah, the rest of these are pretty stagnant, all coming down a little bit, not significant as Melbourne and Sydney, but yeah, they've almost halved their vendor discounting. So pretty significant. Like if you think of $1 million house, if they're discounting it by 7.7%, that's $77,000. So now they're only discounting it by $35,000. So that's half. It's $35,000 less that they're discounting their property by. Pretty phenomenal. Clearance rates average 6.87% over February 2020, up from 46.3% in February in 2019. Yeah, so really strong clearance rates. As we can see here, we've had that sort of slowdown in the January Christmas period, starting to see them come back on the market quite strongly now, which is awesome to see. But yeah, very stronger market again, and it's going to be interesting to see how that sort of Easter period plays out, sort of March, April, and see what happens there. May be an interesting time too, just going on with coronavirus and how the economy is and all that sort of stuff. It's going to be a very interesting year to see how this sort of all pans out. Population growth was 1.5% in the year to June, which sits just below the decade average of 1.6%. Quarterly change in the total population Australia, natural increase Australia, and overseas migration Australia. Yeah, so we're sort of seeing total population is sort of still growing, but at a flat rate. National increase in Australia has come down, yeah, significantly. So come on, millennials, we've got to be having kids, mate. No, I'm wearing that pressure at the moment, so I'm not holding you against it. But yeah, we're seeing that natural increase come down significantly in Australia, and then obviously a bit of overseas migration is happening there. Trend data indices that dwelling approvals are starting to moderate following declines from the end of 2017. So houses and units are still taking a bit of a hit in terms of approvals there. Houses are starting to come up just a little bit, which is pretty awesome to see. So a lot of new construction, not a lot, but new construction coming on the market, sort of coming back up over that flatter period. So be interesting to see what's going to happen with units, if they're going to come up to the same sort of levels as houses and units. Obviously with affordability now becoming an issue, units will become more desirable because they're less expensive and a better entry point for first home buyers and all that sort of stuff. So be interesting to see if they end up matching at some point. The year to January saw further divergence between aggregate credit growth for investors and owner-occupiers. Proportion of mortgages originated in interest-only terms, so we're only seeing interest-only on 13.9% of all loans. Annual change in credit growth, owner-occupier versus investor housing. Yeah, very interesting there. So annual change in credit growth. So not negative growth for investor housing. So investors are showing negative borrowing, where owner occupiers are increased 5.1%. It looks like there, which not increased, but staying at that stronger point. So yeah, pretty crazy. Portion of loans settled on an 80% LVR. So 23% of people are still paying letters mortgage insurance, which is very interesting. I wonder if that considers the first home loan deposit scheme and all the stuff that's happening there with the government and the grants and everything else. But interesting numbers there, still 23%. People have a very high risk profile. Monthly values of new finance commitments, owner occupiers and investors. So owner occupiers is 13.3, what is that, million, trillion, billion, who knows? Monthly value of new finance commitments, 13.3 compared to 5.2 anyway. yeah, pretty hectic there of the significance of owner-occupiers versus investors. Owner-occupiers nearly 3 times the amount of investors in new monthly finance commitments. So pretty hectic there. As we can see, they've taken a much bigger hit over a longer period of time than, and this is all APRA. I'm blaming APRA. They're the main ones for this, but yeah, as we see interest rates sort of coming down now and APRA changes lifted, it's going to be interesting to see what happens here. Portion of new lending for investment housing. So decade average of 36.9%, and now it's down to 27%. So we're much lower as investors at the moment. There's not a lot of investors coming onto the market compared to the decade average. New home lending shot up 4.4% in December 2017. So new homes up 4.4%, the highest growth rate in 3 years. Wow, that's huge. Investor loans were 2.8% higher. However, due to faster growth in the value of the owner-occupied lending, the portion of new finance for investors is at a record low. Yeah, well, investor loans are 2.8 due to the faster growth of values of owner-occupied lending. Yeah, so they're still proportionately lower compared to owner-occupiers, but still a bit of growth there. First home buyer participation rose sharply in Victoria over December 2019, where Queensland and Tasmania saw declines in the portion of first home owner buyer finance. Yeah, so very interesting there, seeing New South Wales, Victoria spiked quite heavily late last year for first home buyers, which is awesome. Get into the market, guys, that's so good. New South Wales taking a little bit of an increase now, but a bit of a dip there as well, so everything's sort of dipping a little bit. Victoria is at 33%, which is interesting. WA is 36%, Northern Territory is 39%, and New South Wales is 23%, South Australia is 22%. Yeah, it was very interesting. So a bit of a mixed bag, but between, sort of 20% and 30% and 40% there of first home buyers coming into the market. Over December, investor participation declined in every state except Queensland and South Australia. Investors as a proportion of total values of lendings. Yeah, so we can see everywhere investors are significantly coming off since 2017. As you can see, New South Wales and Victoria are the strongest 2 markets. They're not too bad though, like ACT, Tas and Queensland are pretty strong. Even South Australia is pretty strong behind as investors as a proportion. But yeah, 32% of investors in New South Wales is pretty significant, and in Victoria as well, 27.8% of them in December 2019 is investors as a proportion. Mortgage rates are now at record lows and are set to decline further in the March cash rate cut, which we saw, which was really interesting. They've documented that now, 0.5%. Looking at another cut in April, everyone's speculating and talking about, especially with the coronavirus and stimulating the economy and everything else. So should be at 0.25% next month, which is going to be ridiculous. And, it's the lowest it's been in recorded history since March 00. So that's the 2000s, which is, ridiculous. Like it's so cheap at the moment, and as we can see with these sort of fixed years and variables and principal and interests, obviously investor lending is going to be more expensive than owner occupier expensive because they want to make a bit more money. But we're seeing a fixed year 3 years for owner occupiers now below the 3s at 2.95. So very, very cheap to borrow money at the moment, and a good time to get in. It's going to have an impact on borrowing capacities and all that sort of stuff. Obviously, I don't know your personal circumstances, so don't take it as advice. But yeah, and you can see this is great. They've shown the difference of the monthly average in new loans. It's 37 basis points between investors and owner occupiers. So owner occupiers to get a mortgage is a lot less cheaper. And that's it, guys. As I just said before, obviously anything that I said today is not financial advice. I don't know your personal circumstances. I don't know a lot of the other markets apart from Melbourne and Sydney. So this is just general in nature and my aspect and views on what's happening on the market at the moment. Very excited to see what's going to happen in a couple of months and what's coming up and everything like that. But yeah, no financial advice. It's just my opinion. So seek your own financial advice if you're looking for that sort of advice and what you should do and what you should invest in and all that sort of stuff. So but yeah, very interesting time in the markets. Interesting month of March coming into April. See what sort of an impact Easter's going to have and the coronavirus and all that sort of stuff. If we see a down turn in April because of Easter and then no recovery because of the coronavirus, and see what's happening to wage growth and underemployment and unemployment and all that sort of stuff. It's all just going to depend on the government and what stimulation they put into the market to sort of stimulate the economy and get people spending money, which is really all we need to do. Yeah, if you haven't watched my recent video on how to invest in 2020 or what I'm investing in 2020, yeah, essentially, you know, it's don't freak out. It's a situation. It's a very critical and health related situation. So it's very important. But you know, all these people that are drastically selling on the stock market and running down supermarket aisles to buy toilet paper is pretty phenomenal. And that's what we see, this sort of sheep mentality. Everyone, you know, people aren't buying toilet paper because they think the coronavirus is going to hit. They're buying toilet paper because the stores are out of toilet paper. So just in case they need toilet paper, they're going to buy it. It's just sort of this flock mentality to just follow everyone and, you know, do things quickly and irrationally and all that sort of stuff. But yeah, pretty crazy and interesting times to see what's going to happen. I want to know what you guys think is going to happen in the next couple of months, so let me know and leave them down in the comment section below. And if you enjoyed this content, make sure you subscribe, like the channel and all the rest of it. But good to catch up with you guys, and hopefully I'll see you next month for the next Corelogics report. But until next time, happy house hunting.